For the past 12 years, something remarkable has happened. We have seen one of the most incredible stock market bull runs of all time. Really, but there's a problem with that. We need a stock market crash, and more importantly, I want a stock market crash. Hey everybody, and welcome back to Dollars and Cents, helping you make sense of making dollars, maybe. I know what you're going to say, what's wrong with him, this bull run's a great thing, besides, we just had a market crash. Yeah, I know. I was there, I saw it too. But here's what happened. Markets were crashing, so the Fed stepped in and said, nope, whatever it takes. Then the market started its near parabolic rise upwards to continue this incredible streak. Mid-February 2020, the S&P 500 peaked right around 3,400 points, but by mid-March the same year, it had plummeted to 2,300 points. That's about 30%. And I'm sure we can all imagine what happened in March of 2020. The Feds in the US stepped in, utilizing these quantitative easing measures with a whatever-it-takes kind of resolve. Now, fast forward just a few months later into early August of 2020, and you find the S&P 500 hits above its high set of 3,400 back in February. That makes this market recovery the fastest market recovery in history. While yes, there were many contributing factors to this historically fast recovery, I think the primary factor in there was that there was no fundamental problem with the companies in the market themselves. Looking at various metrics, we know that stocks weren't too overvalued then. Just look at the PE for January 2020. The average was 27, which is above the normal range of 15 to 20, but nothing that indicates a huge problem. While the CAPE ratio or the Shiller PE ratio was slightly high at 34 pre-crash, it's nothing to indicate something severely wrong with the market itself. Now look at the Shiller PE ratio sitting at 38. That means the expected return of the stock market is something like 2% annually over the next 10 years. 2%, as in 2% like the average bond yield percent. 2% as in the interest rate Discover used to offer 2 years ago. 2% as in if you put $100 in 1 year, you get $2 as a reward. We've talked about the Shiller PE ratio before in my video about Japan. Check out the card in the upper right corner to see that one. We determine this measurement, the Shiller PE ratio, by dividing the current price by the last 10 years of inflation-adjusted earnings. Over the last 140 years, the Shiller PE has certainly been scarily accurate. Oh look, a chart showing the accuracy of the Shiller PE, how convenient. Simply put, the Shiller PE is actually a really reliable metric for determining market averages, and really in the next 10 years we'll get an average return of essentially nothing, at least according to it. If we had a hypothetical market crash, prices would drastically drop, and the Shiller PE of US companies would go with it. Another hypothetical benefit of a market crash is that maybe we get rid of some of these market cheerleaders that have been hyping up random stocks for no reason. Here's my really hot take. Big YouTubers hyping up stocks are wrong and dumb. I'm not going to call out specifics, you very well know the types. These kinds of YouTubers all have one big problem in common. They have no clue what they're talking about. And I can hear you saying it, oh well, you're just saying that because they're successful and you aren't. You aren't some expert either. And I hear you. I do. It's true to some degree that I like taking shots at the big guys because I'm a small fry in a big ocean here on YouTube. And don't get this twisted, I actually really like their content too, at least some of them. But I am going to pick on one guy here for a minute, meet Kevin. He's actually really entertaining and seems like a really cool guy I'd love to meet one day, sure. But he's, well, let's say he's just not my go-to guy for investing advice. He's a bit, dumb about investing. Meet Kevin made a video about Tesla, and he had a price prediction of $6,000 per share by 2030. That would put Tesla at a $6 trillion market cap, 3 times more than Apple's current market cap in 10 years. For a company that can barely sell 500,000 cars in a year and has made more money in Bitcoin over 3 months than they did in 10 years of selling said cars. And don't get me wrong, I'm not generic Tesla hater number 2. I just think that the company is a little overhyped. It's just that Tesla at a $6 trillion market cap and $6,000 per share, it seems a little too bullish for me. I hope we can agree that Meet Kevin is actually a really smart guy, just not about stocks or investing, because, let's face it, he's made all his money in real estate, not in stocks. These big YouTubers, these market cheerleaders, are at base value irresponsible and at worst dangerous. If I made videos with pseudoscience stuff I made up, twisting real science to support my claims after surface research, and amassed an audience that believed me, you'd find that irresponsible too, I'm sure. Maybe a bit dishonest as well. I like comparing these big YouTubers YouTubers to the flat earthers, that group that believes the earth is as flat as a piece of paper like they did in the medieval ages. Flat earthers make themselves sound like they know what they're talking about. They use this, that, and more to justify their claims. It's almost convincing when they talk with such conviction. But we know they're wrong. The evidence all says that the earth is round, not a flat piece of paper. It's the same in finance, but it gets a little harder to determine when someone like a big YouTuber is saying something legit or not. I think a market crash would be a great learning experience for many, and not just the market cheerleaders. Let's rewind to the late 90s. Technology stocks are going crazy because the internet is going to change the world. Companies are going public left and right, adding a .com to the end of their names and getting bid up to insane prices as a result. Some companies caught up in the hype are Amazon, Cisco, Intel, Apple, and Pets.com. Many more went public. Companies like Yahoo, The Street, and TheGlobe.com. All of these companies went public and at the time seemed unstoppable. And as a result, were bought at excessive valuations to the point where it just didn't make sense. Eventually, a crash happened. Some of these companies went back to being private, and overall, it was not a great time for many. A lot of companies didn't survive this crash, and the ones that did, like Amazon, dropped from $107 down to $6. And they stayed there for many years. And many more companies would never reclaim that 1990s high. Some may say we've learned from our mistakes, but have we really? I don't think we have. I think we can very easily repeat history, especially with the influx of new investors joining the market since January of this year alone. What we've got are largely uninformed people hyping up companies that are at their core terribly run or valuations that don't really make sense. Things that can all collapse very quickly, and we're already starting to see that somewhat. Fan favorite companies like CCIV, Teladoc Health, and Virgin Galactic are up to 60% off of their all-time highs. Even the darling Tesla, the unstoppable company of the new millennia, has fallen from highs passing $900 down to just under $700 per share. I think it's perfectly reasonable to think that a good portion of these companies at these valuations might not survive an upcoming crash. Much like the dot-com craze of the 1990s and the early 2000s. I just hope that we as investors are prepared for a crash and not too deep in risky investments that have little chance of working out. With all that said, my next video will examine my process for valuing companies. By no means am I perfect, nor do I claim to be an expert over these big YouTubers or that type, but I think it's important to give you insight into at least one process for valuing and buying into companies. Instead of listening to random people on the internet, be able to look at a company yourself and determine if it has value. If there's one takeaway from this video, I just want you as an investor, new or seasoned, to be careful. There are a lot of people who have good intentions and mean well, but just don't really understand how this investing stuff works. I don't even fully grasp how much of this stuff works, but I'm trying to learn and researching myself. However, I believe I'm far along enough in my own learning to be able to see what some of these guys are doing. But really, I just want a market crash, so I can finally go buy stocks again. But why a market crash? Why is it something that we need? Something that I'm waiting for? Let me just start by saying that I'm a dividend-focused investor, as many of you fans of this channel will know by now. I think I've said it before in other videos. I love market crashes for the opportunities that arise from them. Right now, there are a lot of companies on my wish list that are really expensive and way overpriced. J&J is one such example. A great company, but it's too costly to buy into right now. A market crash could bring its price down to the $100 to $120 range, which would make it a steal. Another example of this would be CrowdStrike, which I've talked about before. Even though CrowdStrike isn't necessarily that expensive, it's a buy and hold stock for me. With a crash, I could buy tons more of the company because I believe it's such a great investment long term. That's what I think a crash really does. It provides an opportunity to invest, to find the companies we like and see a future for, and to think in the long term. Crashes usually occur because of fear in the market. Something bad has happened and suddenly stocks are adversely affected. Even if a crash does happen and the valuations of these companies goes tumbling, I see it as a great opportunity. A great opportunity to buy into some really great businesses. Really, that's what I think this whole channel is about. Investing in great companies. Seeing the potential of these companies and finding the opportunities to invest in them. Instead of just buying stocks in hope that their prices go up and you make a profit. Look for the stocks of great businesses, not just the trendy hot ones, and buy them at reasonable prices. Don't buy Tesla right now because some random guy on the internet told you it'll be $6,000 by 2030. There's no guarantee that Tesla even survives that long. You should really look for companies for the long term, not just for the short term. If you really believe that Tesla can hit 6,000 by 2030, go for it. Go ahead and invest. I'll just leave you with this quote from Warren Buffett. You should look to buy good companies at great prices that you wouldn't mind owning, even if those companies weren't public. That's all I got for this video. I hope you enjoyed this little rantish video. Fight me in the comments below or on my Discord, link in the description. In next week's video, I'll talk about how I evaluate a company and how you can too. Until next time, I hope to see all of you in the next episode of Dollars and Cents.